Derivatives are financial contracts that derive their value from an underlying asset or group of assets, such as stocks, bonds, commodities, or currencies. Derivatives allow traders and investors to manage risk, speculate on future price movements, and create complex investment strategies. In this video, we'll explore the basics of derivatives, how they work, and the key features that make them unique. What are derivatives? Derivatives are financial contracts that derive their value from an underlying asset or group of assets. The value of the derivative is determined by fluctuations in the price of the underlying asset. Derivatives are used to hedge against risk, speculate on future price movements, and create complex investment strategies. There are several types of derivatives, including futures contracts, options contracts, swaps, and forwards contracts. Each type of derivative has its own unique features and characteristics. How do derivatives work? Derivatives work by allowing traders and investors to take a position on the future price movements of an underlying asset or group of assets. For example, a futures contract allows a buyer to purchase an underlying asset at a fixed price at a future date. If the price of the underlying asset increases, the buyer can sell the futures contract for a profit. On the other side of the trade, the seller of the futures contract is obligated to deliver the underlying asset at the fixed price. If the price of the underlying asset decreases, the seller can buy back the futures contract for a profit. Derivatives have several key features that make them unique compared to other financial instruments. Leverage. Derivatives require a small amount of capital to control a large amount of underlying assets. This leverage can magnify both gains and losses. Flexibility. Derivatives allow investors to tailor their trades to their specific objectives. They can be used to manage risk, speculate on future price movements, or create complex investment strategies. Counterparty risk. Derivatives are traded between two parties, and there is a risk that one party may default on their obligations. Volatility. Derivatives are highly sensitive to changes in the price of the underlying asset. This volatility can create both opportunities and risks for traders and investors. Derivatives are a powerful financial tool used by traders and investors to manage risk, speculate on future price movements, and create complex investment strategies. They derive their value from an underlying asset or group of assets and can be used to hedge against risk or to speculate on future price movements. Derivatives are flexible, leveraged, and have counterparty risk and volatility. Derivatives can be complex, and it's important to understand the risks and benefits before trading them. With careful consideration and proper research, derivatives can be an effective way to achieve your investment objectives.